Hi, welcome to this series. We are restarting the series again now but we're breaking it up into two parts. On Mondays, we will cover the markets, and on Thursdays, we will look at some of the discussion topics. And this week, I want to look at factors, and this whole month we'll be talking about different factors and why they work and how they work and their characteristics. So let's start this month with low volatility. Uh, there is something called the low volatility anomaly, which is that no that we've always heard that high risk means high returns in stock market. However, and high risk comes with high volatility. However, that is not the case. As we can see on the screen, um, low volatile stocks outperform high volatile stocks. If 100 rupees invested in the low volatility portfolio of low volatility stocks, 50 stocks would have grown 11 times to about 1175 rupees. The same amount invested in the high beta index, which is comprising of high volatile stocks, would have grown to only 170. So you can see the difference is almost 10 times. And now, if finance theory tells us that high risk is high return, if uh, if you don't take high risk, you cannot make high returns. How is this happening? Why is this anomaly around? And couple of reasons have are typically offered in response to this um, anomaly. And the first one is the lottery effect, which is that investors and it's typically small investors and retail investors, but as we'll see later that this behavior is not limited to them. But a majority of small investors tend to buy high beta stocks because high beta stocks are very news driven. They will be stocks which are in the news, which have some event happening around them. There's been, typically typically a negative event around that, and investors are hoping that this negative event or this negative impact is temporary, and the stock will revert back. We've seen many stocks fall from 400 rupees to 200 rupees, then to 100 rupees, then to 50 rupees, and then to 10 rupees. And then people think, at 10 rupees, how lower can it go? It can go down another 10 rupees, which is 100%. And that's what usually happens, which we will look at next week. That if a stock falls 50% or 40%, what are the odds of that stock recovering? Now, let's assume that that the odds are very low, and the high low volatile outperformance shows us that. Then why do investors buy them? Like I said, investors have some of these investors who are typically buying these kind of stocks have limited capital, so they want the highest bang for their buck. So if you have 100 rupees, you want that 100 rupees to grow to 500 rupees, and in a short period of time. So that's what happens, and that's what so it's called a lottery like payoff, or like an option like payoff, where there is either you make double your money or just lose it all. And the second is the agency effect, where uh, most fund managers, and this is typically in high risk hedge funds, where they are going to get a percentage of the profit. Now they have no participation in the downside. They only have a participation in the upside, and they want to buy high risk stocks or highly volatile stocks, which may have the probability of moving much higher. If it moves higher, they get their share of profit. If it moves lower, then they are not impacted much, because they're anyway going to get their fixed salaries. So that has, the agency effect and the lottery effect together create high demand for these high beta stocks. and that typically results in that people overpay for these kind of stocks. And when you overpay for something, you are not going to make returns on that. And this, you might think, why is this not arbitraged away? Why doesn't this effect go away? It doesn't go away because human behavior does not change so fast. Human behavior takes decades and centuries to change. Maybe in another few decades this impact may go away, but this anomaly was first detected in 1970, and it's been 50 years. The anomaly is intact, and it's not been arbitraged away. So there's a very small chance that it will be arbitraged away in the near future, in the next 10, 20, 30 years, which is our investment horizon. So sometimes even these professional investors have leverage constraints, so that they're running large sovereign funds, pension funds, hedge funds, and they cannot take leverage. So if you buy a stock for 100 rupees, which has a beta of say 1.2, that means if the market moves by uh, say 10%, this stock has the potential to move by 12%. So implicitly, there is some amount of leverage built into your position. But the same thing can happen on the way down. If the market falls by 10%, your loss will be 12 because the beta is 1.220, uh, which is 20% higher than the market movement. So with that, we come to an end to today's video. Um, Look up the low vol index. These indexes are available on the. There are some mutual fund houses which have launched ETFs and index funds on this index. So look them up. And until next week, see you. Just the normal disclaimer that this is not investment advice, it's purely for educational purposes, and please consult an investment advisor before investing. And you can follow me on Anish Daily at QEDCap on Twitter, and visit our website at www.qedcap.com. And please do like, subscribe, and follow our YouTube channel. And if you have any questions on the low volatility anomaly, or any other questions on factor investing or investing, please do write into us, and we will get back to you. Thank you, and see you next week.